The Great Depression, a period of profound economic despair, began with the notorious Wall Street crash of 1929. This catastrophic event not only symbolized the end of an era of prosperity in the United States, but also marked the beginning of a decade-long struggle for survival and economic stability globally. The Roaring Twenties, Prelude to the Crash. The 1920s, often referred to as the Roaring Twenties, was a decade characterized by remarkable economic growth, technological innovation, and widespread optimism. The United States emerged from World War I as a dominant global economic power. This period saw rapid industrialization with significant advancements in transportation, communication, and manufacturing. The stock market, in particular, became a symbol of this prosperity, drawing in millions of new investors lured by the promise of easy wealth. The bubble bursts, Black Tuesday. The stock market crash, which culminated on October 29, 1929, known as Black Tuesday, was not an isolated event but the result of a series of economic missteps and speculative investments. In the preceding years, stock prices soared unrealistically high, driven by reckless investments and margin buying where investors borrowed heavily to purchase more stocks. When the market began to wobble in late 1929, panic set in. Investors rushed to sell their shares, leading to a catastrophic downward spiral. Economic domino effect, the descent into depression. The aftermath of the crash was immediate and devastating. Millions of investors were wiped out and consumer confidence plummeted. This decline led to a drastic reduction in spending and investment, causing a ripple effect across the economy. Businesses began to fail, leading to mass unemployment and wage cuts. By 1933, unemployment in the United States had soared to 25%, and global trade had halved, exacerbating the economic woes internationally. The banking crisis, a crippling blow. The banking sector, heavily invested in the stock market and speculative loans, was hit hard. As banks began to fail, it triggered a panic, and people rushed to withdraw their savings. This banking crisis compounded the economic turmoil, leading to a further decline in consumer and business spending. The Dust Bowl, nature's cruel contribution. Compounding the economic disaster was the Dust Bowl, a severe ecological and agricultural crisis that devastated the American Midwest. Prolonged drought and poor farming practices led to soil erosion and dust storms, rendering millions of acres of farmland unusable and displacing thousands of families, further worsening the economic situation. The global impact, a world in despair. The Wall Street crash's impact extended well beyond the United States. Europe, still recovering from the devastation of World War I, was heavily dependent on American loans and investments. The crash led to a withdrawal of American funds from Europe, causing a financial crisis that rippled across the continent and beyond. The road to recovery, the New Deal and beyond. The response to the Great Depression was multifaceted. In the United States, President Franklin D. Roosevelt introduced the New Deal, a series of programs, public work projects, financial reforms, and regulations. These measures aimed to provide relief, recovery, and reform to a nation in crisis. Although the New Deal did not end the Depression, it provided significant relief and reformed many aspects of the American economy. Conclusion: lessons from the past. The Great Depression and the 1929 Wall Street crash serve as powerful reminders of the vulnerabilities of the global economy. The events of 1929 demonstrated the dangers of speculation, the interconnectedness of global economies, and the need for regulatory oversight in financial markets. The lessons learned from this period have shaped economic policies and financial regulations for generations, highlighting the importance of vigilance and responsible economic management in preventing future economic catastrophes. Reflections and Reforms: A New Financial Landscape. Implementing regulatory measures. In the wake of the Great Depression, it became apparent that stringent regulatory measures were essential to prevent a recurrence of such a crisis. The United States government introduced significant financial reforms, most notably the Glass-Steagall Act of 1933, which separated commercial banking from investment banking. This act aimed to curb the speculative excesses that had contributed to the Wall Street crash. Additionally, the Securities and Exchange Commission, SEC, was established to regulate the stock market and protect investors from fraudulent practices. The shift in economic theories. The Great Depression also ushered in a paradigm shift in economic thinking. The crisis challenged the then-dominant classical economic theories, which could not adequately explain the prolonged economic downturn. This led to the rise of Keynesian economics, founded by John Maynard Keynes, advocating for increased government expenditures and lower taxes to stimulate demand and pull the global economy out of depression. Keynesian economics profoundly influenced government policies in the subsequent decades. Global economic realignment. The economic turmoil of the 1930s reshaped the global economic landscape. With the decline of European economies, the United States emerged as the world's economic powerhouse. The establishment of the Bretton Woods system in 1944, creating the International Monetary Fund, IMF, and the World Bank marked a significant step towards a more regulated and stable global financial system. These institutions aimed to foster international monetary cooperation, secure financial stability, facilitate international trade, and reduce poverty around the globe. Social and cultural impact. Beyond economics, the Great Depression had a profound social and cultural impact. It led to a generation characterized by frugality, risk aversion, and skepticism of financial institutions. The experience of widespread poverty and unemployment left a lasting impression on public consciousness, influencing attitudes towards welfare and social support systems. This period also saw significant advancements in arts and literature, with works often reflecting the struggles and resilience of people during these challenging times. Technological and industrial advancements. Despite the economic downturn, the 1930s witnessed remarkable technological and industrial advancements. The New Deal, through its public works projects, facilitated infrastructure development, including bridges, roads, and dams. These projects not only provided immediate employment, but also laid the foundation for long-term economic growth. Innovations in various sectors, such as aviation and communications, continued, setting the stage for post-war technological advancements. The prelude to World War II. The global economic instability of the 1930s also set the stage for World War II. The economic hardship in Germany, exacerbated by the Depression, contributed to the rise of Adolf Hitler and the Nazi Party. The war that followed would reshape the world order yet again, bringing an end to the Great Depression but at a tremendous human and economic cost. Epilogue: The Enduring Legacy. The Great Depression remains one of the most studied periods in economic history, offering invaluable lessons on the dynamics of financial crises, the role of government in the economy, and the global nature of economic challenges. Its legacy is evident in the financial regulations, social welfare programs, and economic policies that continue to shape our world. Understanding the causes and consequences of the 1929 Wall Street crash and the Great Depression is crucial for policymakers, economists, and the public to navigate the complexities of the modern economic landscape and to prevent future financial disasters.